The other day, I was listening to a friend who was complaining that his shares on the Australian stock market had gone absolutely nowhere for several years. He was expecting sympathy, but he didn't get any because I've run out of sympathy for people investing in the Australian market and have done for some years. So rather than explain yet again, I decided to show him just one single chart. We're looking at the comparison between the indexes, the main indexes in Australia and the US. So the S&P 500 is the dark blue line going up, and the paler blue line on the bottom is the Australian All Ords. Now I chose the post-GFC, just the last 20 years or so, and we can see what's actually happened. The Australian market has gone up 155%, which sounds very nice, until you actually look at the US market, which has gone up 845%. In other words, it's gone up more than 5 times as much. Yet Australians still invest in the Australian market, which is dominated by mining companies and banks. It's called home bias. They invest close to home. It's not just Australian. It happens in other countries too. But of course, it occurred to me that maybe I had home bias, or rather away from home bias, that because I invested in the US, that I thought it was the best. So I thought I had better check it out. So the first thing I had to work out was a time period. Maybe the GFC, maybe post GFC wasn't a good time to do it. So I thought, well, let's just go to the start of the century, the last 26 years. And so this is the same chart, but from about 8, 9 years earlier, starting 8 or 9 years earlier. The All Ords, Australia, and the S&P 500 in the US. Now we can see that initially, at the beginning of the century, Australia was doing very well, mainly because it didn't really suffer in the tech wreck. The reason would be obvious, because Australia didn't have any tech companies, so we weren't punished quite as badly as the rest of the world. And so just before the GFC, we were riding very high. But after that, it wasn't such a nice story. You can see that it took 12 years for us to regain the level that we were at before the GFC. However, the end result is slightly better. The All Ords went up 213%, and the SPY went up 484. But the US still outperformed it more than double. So, but maybe we need to start looking elsewhere. So it could be that the US was lucky and Australia was just unlucky. So let's go over to the UK, to England. Now their main index is called the FTSE. So let's see how the FTSE did. Now the FTSE is the green line, and you can see that it didn't do very well at all. In fact, from the years about 2000 to about 2021, it did absolutely nothing. It was worth the same at the end as it was at the beginning. Now, during that time, of course, inflation was there, and it went up about 76%. So just by using a buy and hold, you did not do very well at all. In fact, you lost a lot of money. And even since then, it's gone up slightly. So over the 26 years, it's gone up 76%, which would obviously be less than inflation. So it rather shoots a hole in the idea of its time in the market, not timing the market, that counts. I'm afraid that's one of the aphorisms that just pretty well infuriates me because it's so obviously incorrect. Okay, maybe it is UK was unlucky too. Now, Germany, with its manufacturing, has a great economy. Its stock market must be better, surely. Now, the main index in Germany is the DAX. So let's see how that did. Right, now we're looking at the yellow line, the yellow kind of mustardy line. And we can see that Germany has been doing quite well. So about 388%. Not quite as good as the US, but very, very nice. What is interesting is if you look back at the early part, you can see that it really was very hard done by in the tech wreck. It started off very well, and then it really crashed to more than 40% by the looks of it, reading off the chart. However, after that it recovered, and in recent years it seems to have been doing very well indeed. Let's look at its neighbor, France. France has a lot of global companies. The index is the CAC or the CAC. I'm never sure what to say there. So let's compare with all the others and see how France did. Right, the turquoise line, right down the bottom. And it's not a pretty story. My French is not very good, but the French, ils ne sont pas heureux. In other words, they're not very happy. Because for 26 years, and they've ended up less than where they started. And that's not accounting for inflation. So there'll be a lot less than when they started. So not really a very happy story there. In fact, apart from Germany, Europe does seem to be a bit of a basket case. So let's try the other side of the world. We'll go over to Japan. Now, the economy there was admired for many years, not so much recently. So therefore, let's find out if it's regained its former glory. Right. Japan is the red one, and you can see it's a bit of a late bloomer. It did very, very badly up until about 2021, and since then it's popped up very nicely. So overall, it's gone up about 300%, which means that it comes in third after the US and Germany. So which country wins? Well, the charts have told the story, and the lesson is that the market that you choose matters. If you've got a great company in a good economy and good share market, it's swimming with the tide, it's got a tailwind. But the same company in a different environment, it has to work much harder just to stand still. So the question was, were we right to choose the US? It does seem like our choice of the US market was the right one. It certainly has beaten all of the others that we've looked at. Of course, indexes aren't the full story. It's the effect on your account that matters, but that's for another blog. If you'd like to explore the complete ITM plan, along with more articles like this, you'll find everything at heathercullen.com.